Hey everyone, Chartographer here. Look, I've been in these markets for years, crypto included. I'm just going to come out and say it. I think Bitcoin has already bottomed. I know, that sounds a little wild right now. Between the war headlines and everyone on X or YouTube screaming about a total market crash, it's not a popular opinion, but I'm calling it. I think 63K on February 24th was the floor. Right now, we're just in that boring accumulation phase before things really take off late this year and into 2027. But stick with me for a second because I want to show you exactly why I'm seeing things differently. So, I want to show you one of my favorite setups. It's basically how I look at the market from a few different angles at once so I don't get that tunnel vision. So here's a breakdown of what we're looking at. The top, just a standard Bitcoin price chart. The middle are two sections for open interest, one for USD margin trades and one for coin margin trades. So basically how much money is currently bet on the market. The bottom is the total funding rate. So check this out. It's a very simple observation, but it's honestly incredibly powerful. Whenever the net funding rate at the bottom stays in negative, the red zone for a long time or on the daily or weekly charts, it almost always marks a major bottom at the market. It happens with crazy consistency, and you can see it right here in the past cycle. Here, here, and again right here. So, why does this work so consistently? Think of the funding rate as the fee for the trade. Usually people are bullish, so they pay a fee to stay long. But when this rate stays negative for weeks, like it is right now, the script flips. Suddenly the shorts, or the people betting the price will go down, are actually getting paid just to keep the positions open. This tells us two big things. One, everyone is bearish, right? The market is so convinced we're going lower that the shorts are comfortably dominating. Two, the longs left are the tough ones. The only people still betting on a move up are the well-capitalized, stubborn investors who are willing to pay that fee because they aren't budging. This creates a massive imbalance. Because the shorts are actually being compensated to stay in the trades, they get lazy, overextended, but eventually they run out of new sellers to keep the momentum going. At that point, it only takes a small bit of buying pressure to spook them. As soon as the few shorts start closing their positions to protect their profits, they have to buy and exit. That triggers a chain reaction, a short squeeze, that launches the price upwards and flips the funding rate back to positive. The reason I'm so focused on this is that we've been in this negative zone for 3 weeks straight, ever since February 24th. This is the exact same signal we saw at every major market low in the past. So when you combine this with the fact that we are seeing a huge surge in CoinM hedging and zero USDM FOMO, which we'll get into a second, that's a classic sign of seller exhaustion. It's the quiet before a storm that usually starts a major accumulation phase. Alright, next let's look at the USDM open interest. That's the second panel on the chart. Think of this as the fresh money meter. When these lines go up, it means a wave of new cash is hitting the market as people open new bets, whether they're going long or short. So in my experience, this specific chart is like a mirror for retail in motion. It usually peaks right when everyone is hit by FOMO at the very top of the cycle, and it bottoms out when the average Joe has completely given up at the low. Now take a look at panel 2 again. You can see that the USDM open interest peaked at around $36 billion right when Bitcoin was hitting that 125k mark. Since then, it's shriveled up, dropping by about $20 billion, and we're now sitting at roughly $17 billion. I think this specific spot is so fascinating and you really need to pay attention to it for two main reasons. 1. It's a history repeat zone. This is almost exactly where we were back in the spring of 2025. Back then, Bitcoin bottomed out around 77k before it went on that massive run all the way up to 125k. 2. The $15 billion floor. I personally took that $15 billion level as a major psychological support. Think back to late 2024, before President Trump won his second term. We had never really seen the market break above that $15 billion mark. But when a pro-crypto president took office, it changed the game. It brought in a huge wave of new legitimacy and fresh capital that blew past the old resistance and more than doubled the market. So here we are again, coming back down to retest that $15 billion area. I'm expecting it to hold, but it's definitely the number one spot I'm monitoring right now. Lastly, let's look at the CoinM open interest. That's panel 3. To keep it simple, CoinM stands for coin margin contracts. You might also hear them called inverse contracts. This isn't really where the average retail trader hangs out. This is the playground for big players like the miners, institutions, serious hedgers who already own the actual coins and want to protect their bags or play volatility. In my experience, this chart behaves completely different than the retail heavy USDM market we just looked at. Here's the secret. When you see the sudden surge in coin activity, it's usually warning that a massive move is brewing because the smart money is getting active. In fact, one of my highest accuracy rules is this. When the coin activity peaks, it almost always marks a major bottom. And it's the opposite for the tops. It's like the pros are moving their pieces onto the board right before the game changes. Take another look at panel 3. You will notice that coin open interest spiked massively during the price drop in March, right as Bitcoin was hitting its lowest point. Since that big jump, things have calmed down, and now it's just growing at a slow, steady pace without any wild swings. Think of this as a smart money hedging panel. When you see it spike hard at the lows and then just settle without going wild, it usually means that big players are done protecting their bags and are quietly moving into the next phase. This exact pattern has shown up right before every major accumulation period I've ever tracked. So here's where we are. CoinM has come off those peak levels and is holding steady. To me, that stabilization is exactly what we need to support this accumulation phase we're in. It's a huge indicator to watch because the moment we see a fast surge in CoinM activity, that's likely the signal that the next big leg up is about to hit. So when you step back and look at all three of these panels together, the picture is actually incredibly consistent. First, we have the funding rate staying negative for weeks. That's your classic SLR extraction signal. That's marked every single major bottom I've ever tracked. Then panel 2 shows us that the retail crowd got way too emotional at the top, dumped a massive amount of leverage, and is now testing that $15 billion support level again. Which, remember, is exactly what happened right before our last big run up. And finally, panel 3 shows the smart money has finished that big hedging surge for the March low and has now gone quiet. So when you add it all up, every single indicator is saying the same thing. Bitcoin hit a major bottom in March, and we are now in the early stages of the accumulation phase. I expect this slow and steady grind to continue for the next few weeks. You see the strong hands quietly moving in while the average retail traders stay nervous and cautious. But once the panels start showing fresh momentum at the same time, that's when the next big leg up officially kicks off. So, keep a close eye on these three spots. They've been my most reliable tools for years, and right now they're all pointing at the same bullish direction for the long term. That's the full picture for today. I'd love to hear what your take on this. Let me know what you think in the comments, alright?